Hey guys, Max here, and yesterday stocks fell in pretty dramatic fashion as investor sentiment continues to take major hits based once more on fears from the dreaded Federal Reserve. It seems that no matter how great earnings may be, the risk posed by monetary tightening is just too great for investors to stomach. Now, before we get into the meat of the video today though, we have just set up a Stoic Media Twitter account that will be used to publish videos and articles in the future, so make sure to head on down to the description of this video and follow that account so you don't miss out on the articles that we'll be pushing out soon. Also, give my personal Twitter account a follow as well. So how bad was the market actually? Well, as you can see, it was pretty damn bad. The S&P 500 as a whole fell by 1.5% for the day, and the Nasdaq fell by 2.1%. Tech especially did quite bad, as did financials, healthcare, energy, materials. In reality, most sectors fell. The only real bits of green you can see there are Tesla and AT&T. The rest of the market was just pretty poor. In Europe though, things did fare a little bit better. There weren't major gains or losses. The FTSE 100 was stagnant and didn't really move throughout the entirety of the day, but the Stoxx 600 did rise slightly by about 0.2%. The dollar is strengthening again against the euro, the yen, and the pound. All of those other currencies fell. The pound now is at $1.30 per pound. That is the lowest point it's been at for about the last 2 years, really since lockdowns created chaos in the first place. Just a few months ago, the pound was sitting at about $1.38, so this is a pretty major decline. Bond prices continue to collapse. The US 10-year Treasury yield rose by about 7 basis points to a new 4-year high. It seems like we've been saying that every week now, and actually we have been saying that every week because every week we've been reaching new highs on bond yields. Right now, that's sitting at 2.9%. German 10-year yields rose as well, up 9 basis points yesterday alone. They are almost now sitting at 1%, and let's remember that German 10-year yields used to be distinctly negative for a long time. The British 10-year yield rose by 10 basis points, now it's sitting above 2%. Bond prices right now are really low. They have been crashing consistently week after week, and this crash in fixed income assets probably hasn't stopped yet, as the Fed hasn't even really begun to sell off their balance sheet. Now, oil prices have actually been relatively consistent over the last few days or week even. WTI crude oil is sitting at $103 a barrel. Brent crude oil is sitting at $106. That downwards pressure that we saw for a few weeks seems to have mostly ended. There aren't really any more supply or demand shocks happening right now, but prices just aren't falling. Gold prices are staying high, but they're not rising much higher. Right now, gold is sitting at about $1,940 an ounce, finding a lot of resistance and support around that level. Now finally, in crypto, what happened for the day? Well, actually, the market fell about 3% for the most part. Bitcoin is down to $40,000, sitting just above that mark at the time of me making this video. Ethereum is sitting just below $3,000, so there has been a fair-sized dip overnight. In general, risk on assets fell yesterday, like what we saw it happen with the Nasdaq and tech companies, and so crypto followed that trend. Based really on the worries of what the Fed and Jerome Powell especially came out and said, that is very normal these days. Now, altcoins, of course, are a little bit more volatile, as they always are. They fell a little bit more than Bitcoin and Ethereum, mostly about 4 to 5% for the day. Tron, though, rose quite a lot, up 8% yesterday. It's doing really well and actually beating the rest of the market on this idea that it's going to create a decentralized stablecoin, which is really quite bullish. If you want more information on that, then leave a comment down below and let me know. And I will make a short video on Stoic Crypto, my other channel, so make sure to go check out that channel and subscribe so you don't miss out when that comes out. So, stocks did badly, yet most people were expecting them to be characterized by the earnings reports, the corporate earnings that we're going to have coming out over the next couple of weeks. So how have those earnings reports actually been? Well, they've actually been really good, and yet stocks have been falling. Now, that doesn't really line up, does it? In the S&P, there are just over 500 companies, and 87 of those companies have recently posted their Q1 results, and 80% of those 87 have actually beaten their estimates, which is really good, and so these stocks should be rising on this news, right? The problem is, they're not, because these earnings are just totally overwhelmed by the tightening monetary environment. One of the only companies to actually break this trend is, of course, Tesla. It is the most speculated stock on in the world, and it's sort of an ecosystem of its own. Tesla did seriously beat its estimates, as have a couple others, yet all these other companies are down on their news while Tesla is still up. Snapchat is quite a big and important company. It is always the first major tech company to report their earnings for each quarter, so it's seen as sort of a bellwether, especially for advertising revenue, and their earnings were actually quite good. They saw 332 million daily users, that is 18% year-over-year growth. They beat their estimate for daily users by 2 million people as well, so that's pretty strong. They did miss their sales forecast, $1.06 billion compared to the estimated $1.07 billion, so only a slight miss, but still a miss. Still though, that is 38% year-over-year growth, so a strong performance there from Snapchat. To top it off, Snapchat is also expecting revenue growth of 20 to 25% for the next 2 quarters, which is really bullish. The company is still not consistently profitable. They did have one profitable quarter at the end of 2021, I believe, but this last quarter was a net loss of $360 million. The CEO came out and said, while we are pleased with our progress given the macroeconomic environment, we also recognize that we have a significant amount of work to do to realize our long-term opportunity. They also said that revenue growth was really good, but that they lost some of it as the war in Ukraine caused ad campaigns to slow down or stop for a few weeks. Snapchat, like most social medias, were recently hammered by Apple's changes that made it harder for them to collect data on iPhones, and that means that their adverts that they can sell are less valuable as they're less targeted. Now, on this earnings report, Snapchat's price jumped by about 9% after hours, but then it sort of chilled out, and right now as I'm making this video, before markets are open, the stock is sitting pretty much where it was before earnings at all. It is worth pointing out though that the company has not been doing well over the last year. Despite some decent growth prospects, it's now down at 64% in price from its all-time high back in 2021. It seems that even good earnings reports can't fight this bad investor sentiment that we're seeing these days. Now, the narrative that is being pushed is basically that earnings are up for these companies, so the company's values should go up too, and we should see the stock market as a whole increase. And that did hold true for a small period of time over the last few weeks as we had that decent rally, but now investor priorities have shifted once again to trying to predict what the Federal Reserve is going to do. To put it very simply, markets are absolutely terrified by Jerome Powell and the influence he holds over the economy and thus asset prices. They are terrified that he's going to tighten the monetary environment more than he needs to, and that he's going to cause a hard landing that will lead to a recession. Now, in reality, the Federal Reserve probably is going to cause a recession because, in my opinion, and in many other people's opinion as well, a hard landing is inevitable now. Inflation is too high, and if you want to rein it in, you have to crash the markets. That's just the simple truth. There isn't any way around it. Now, as earnings season continues, the most important ones will of course be the biggest companies, as you would expect. Google, Apple, and Amazon are all ones to look for especially, but smaller ones like Netflix and Snapchat have influence on investor sentiment too, and they can't be ignored. Once again though, Tesla seems to be the exception to the rule. It moves in its own way. It's probably the only growth stock that hasn't been hammered over the last year by the change in valuations of growth companies. How long that lasts, I don't really know, but as of yet, it is holding true. So now the big news that actually shook markets was the Federal Reserve's comments, or rather Jerome Powell. He came out and spoke and he said front-loading of policy is needed to cool the economy. Basically what that means is that he's going to hike rates by large amounts now and then smaller amounts later. Now the Federal Reserve is obviously currently doing the bare minimum of rate hikes of 0% for the vast majority of the last year to 0.25% for the last month. Now what that means is that if the Federal Reserve is going to front load the interest rate hikes, then they have to do rate hikes of 0.5 or even 0.75% hikes. Powell specifically said that 0.5% hikes are on the table for May, which is only about 3 weeks ago now. Will he actually have the balls to do what is needed when the time comes? Maybe. To be honest, I doubt it. And if we look back at his history, he hasn't had the balls back then, so I don't expect him to have them now. He also said that one of the major dangers that the economy is facing, and thus the markets as well, is the fear of too few workers, too many job openings. And this is obviously a little bit ironic. It's pretty much his fault that the job market is so screwed. He focused purely on unemployment for so long, and now he's done too much damage. Now, the idea here and what the Fed is actually scared of is what we call a wage price spiral, where wages rise and that impacts prices because, of course, wages impact the input costs of goods and services. And so then as prices rise, wages have to rise to counteract that, and it leads to a spiral, a positive feedback loop where they play off each other, and that can lead to absolutely huge inflation, which is very dangerous. Now, we're not there yet. Wage growth is still negative in real terms, which is a little bit easing to those worried about this, but it is, of course, very possible, and it is a major fear for the Fed, something that they are paying very close attention to. As of right now, the Federal Reserve's asset buying program is finally over, but the Federal Reserve's asset selling program is expected to start soon. It hasn't yet started, but the Fed did signal that they will announce what they will do regarding the reduction of their balance sheet in May. Again, that's only 3 weeks away, so that's also going to be a scary point that people are looking for, investors especially. Now, we are expecting the Fed to announce that they could go as high as $95 billion a month in asset sales. This would, frankly, though, tank bond prices even more than they are already falling by every day. Asset prices would probably get hit majorly as well. I would not expect them to go straight into this system that heavily. I'd expect maybe $40 billion of asset sales a month to start off and then see how the markets react. But $95 billion is apparently the upper limit of what they are considering. Now, as that is 3 weeks away, the next 3 weeks is likely to be uneasy. Come mid-May, either a market rally will happen as the Fed will be dovish, or a market crash will happen as the Fed is hawkish. And until then, investors are probably going to be quite wary about putting money to work in capital markets because they don't want to make a mistake based on what the Fed might do in the future. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stablecoins to protect your hard-earned cash from being eaten away by inflation. Thank you for watching. Stay stoic. Until next time.